Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. We've seen a pause, for 2 weeks or so, from the definitive break lower from the second flatter, but also lopsided and larger January to mid-June diamond pattern. It's the one that's highlighted in bright red on my daily chart, as compared to the original February to late May diamond pattern. Over the last few weeks, prices have pushed down enough to break through and close below the following: the 2016 high at 179.55, the influential neckline currently at 175.95 of the January 2020 to April 2021 reverse head and shoulders bottom, and the congestion, quite a lot of congestion in fact, between 174 to 74.5, containing the August 2021 low at 174.5 and a 50% Fibonacci line, the May 2019 to February 2022 move at 174 even. These are now resistances. Prices then went down through a fairly free area, all the way down to punch down through the 2017 high at 159.30 and finally reached the primary target X in the 156.35 zone for the lopsided diamond pattern. We still have the secondary harder to reach target X1 down in the 141.80 zone. Okay, so there are two further ingredients I'd like to throw into the mix. As of 5 Thursdays ago, we had a bow tie formation of the medium moving average, currently 179.10, and the short and long moving averages, currently 161.75 and 175.95, respectively. They originally seemed to be in no order, nor indicate any direction, but they did cross over and subsequently headed lower. The theory would also indicate potential move between the 6th and the 13th of July. Well, we may not have seen a major move lower, but it would point out apart from possibly today, and we are having a new fresh low at the moment. The 12th of July had the lowest close since January this year, so there is some compensation for that pattern. So to look on the downside, keep an eye out for the support that may be in the Fibonacci congestion below in the 153.60 to 153.30 zone. Then the August 2017 high at 147.25, and finally the congestion between 143.35 to 142.75, just above target X1 containing the 2019 high at 142.95 and the September 2017 high at 143.35. London coffee. A major incident happened in this market 3 weeks ago, and one that takes this daily chart off my most favoured chart list. We saw the market punch down through and close below the lower time, currently at 26.91, of the major January to March bullish Andrews pitchfork, which is highlighted in dark blue on my daily chart. This bullish pitchfork had been running the market higher in, to be honest, a perfect pattern since roughly about mid-March. Prices also closed below the March 2011 high at 26.72 and the June 2011 high at 26.41. Perhaps most importantly, below then and then above and then below again the rising short medium moving average, currently 25.77. Looking below, we had support at 25.18 penetrated, but prices managed to effect at least a temporary repair to that breach low, though I'm increasingly unsure how long this might last. The supports at 24.68, 24.11 and 23.95 are still good, as is the rising medium moving average, currently 24.15. There is still a chance that this pitchfork may repair itself, but it seems increasingly unlikely, and the longer it delays any repair, the harder it will be to make it happen. Hence I started to look to see what alternative patterns could show themselves with such a rapid move lower. And I came upon a potential and possible pattern. It's a possible bump and run reversal top. Now this fits in with the concentrated action back in mid-June and the subsequent fall. Okay, so in this instance for such a pattern, I'm going to finesse some of the points related to the build-up to the bump. Instead of utilizing the lower trend line for the rising action, I'm going to use the lower time. Now, I know this is a bit radical, but I think it might be the most appropriate way to pay credence to the bullish Andrews pitchfork, yet at the same time acknowledge the situation as it may now stand. Thus, I would look for initial target X in the vicinity of the April highs and May lows around the congestion at 24.11, and the lesser Fibonacci line at 23.95. This could also tie in with the rising medium moving average that's below. I would then suggest a secondary, harder, much harder, potential target X1 in the zone around the highs of late February and early March at about the lesser Fibonacci line at 2203. I fully expect to make some further potentially even drastic finessing of these in the coming weeks.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.